I'd like just to first thank everyone for a great day. I think it's our it's our third edition. We're gonna repeat that probably here next year. We're gonna do it in Asia in the next few months. I think in September. So again, thank you very much. Thank you to our panelists and speaker for making themselves available during the prep session, and obviously. Very insightful exchanges. Frankly speaking, I've learned a lot today, so thank you very much. Thank you to Natixis team, Natixis CIB for organizing the event. Great venue. Thank you for the aircon, by the way, as well. And of course, thank you to our clients and business partners that have been traveling from far for their continued trust and support. So, brief note, private credit obviously is not nascent. It's not, new to anyone. You've said that at length. It's been, decades in the US that this market has been, growing, especially on the back of institutional money. It has been, gaining traction in Europe and somehow in Asia. Probably more in the last decade on the back of zero rate era, and especially on the back of LIFR, which were, and we said that at length, looking for diversification, and also a very capital efficient asset class that was offering both a very predictable asset class in terms of cash flow, and as well high return, especially in comparison with the publicly traded bonds. That was mostly centered around high grades, by the way, infrastructure and real estate. What we are currently experiencing is an impressive acceleration and somehow democratization of the asset class, but more importantly, a structural change in the way we are basically funding the credit market. I've heard PGIM and BlackRock talking about connecting the dot between a new set of investor and a new set of assets. This is where we are. We know the driver. One is obviously a massive demographic pressure on the retirement system, which is currently leading to an accumulation of long-term capital in the hand of pension funds that are looking to outsource their asset management and origination. We were talking about Australian market. We have some friends from Australia, from Sydney. Think about Australia and the superannuation market. This is today almost more than one time the GDP which is run by the superannuation. Should be 2 times in the next 4 years. And I was meeting with Aussie Super. They've got 200 million cash to invest per day. We have not spoken about sovereign wealth fund, but I think this is also a very strong dynamic, different dynamic, but sovereign wealth fund in the Middle East, in Asia, probably on different dynamic on the back of commodity prices. Holland, Denmark, even the Mexican Afores pension fund are doubling in size and increasing their allocation to private debt. So that's the first driver. The second driver is, we've been discussing that, but regulatory pressure on banks, which we are also, experiencing on our side, related to capital, related to liquidity, related to leverage, related to balance sheet as a whole, which is putting pressure on banks and making them probably a bit less competitive in the way they are doing their business, especially in a world where we have, dry powder which have exploded, and a world where fully integrated credit setup have emerged. So there's a number of credit funds, PE funds, sponsor, who have become all at once, credit manager, insurance company, you name it, platforms, which offer, borrower, I would say, compelling terms, ability, fast execution ability, and large underwriting. So that's the way where we are competing, and I do agree. And coming back to the first probably panel on do we win or do we lose, I think it's a win-win game as far as we are able to work together. And there's a more structural aspect, is the environmental, technological, societal change, which is driving obviously structural funding across multiple industry, from healthcare to infrastructure to power. But more importantly, the urgent need to raise private capital, especially in a world where public deficits are worsening. So we've been discussing about the retail at length. Well, personally, when the retail start to invest in an asset class, we should be very careful on the pricing dynamic and as our friend from Pico would say, the credit risk factor. But this is where we are. So this is, a world full of opportunity. I think our business model are evolving. Some banks are building their credit ecosystem on their asset management arm. Others are building their ecosystem partnering with credit funds. Others are building through, their underwriting and balance sheet capacity, and probably through their merchant bank. Us at Natixis, we build certainly on expertise and content. And we certainly build on our agility to provide, temporary capital and capital market access. We've been saying that we are part of Group BPCE, which is one of the largest, originator across multiple, asset classes, from retail to SME to real assets to lev loan to portfolio. And we are happy to work together with you. We also have been, setting up what we call an originate to distribute model since a decade to support our risk recycling efforts on a daily basis. We are risk recycling our assets. We sell roughly 60 to 70% of what we underwrite every year, which represents 60 to 70 billion every year. Across several asset classes. We serve a number of clients globally. And obviously, we like to work together with you on structure. You may have discussed with the team, but we are currently looking to place the first infra CLO in the market. We are also out on our unitranche corporate funds as well, in the coming weeks. The driver of our business, and I will be finishing here, just have in mind, we are able to basically offer you the full range of services from portfolio financing on performing, non-performing, reperforming, very interesting market that we have not discussed, loan, all the balance sheet management, access to funding and securitization, and obviously hedging capabilities on rates, on FX, including acquisition hedging. So again, thank you very much for your time. I hope that you enjoyed the day. It's not yet finished, but we're going to have a drink all together, and thank you again.